What if the silver price you see on your screen is no longer the real price of silver? What if governments already understand something that most investors still don't, and the biggest change in the silver market is happening quietly behind closed doors? Across the world, strategic policies are shifting, industrial demand is accelerating, and physical silver is beginning to tell a completely different story from the paper market. Is this simply another temporary market distortion, or the early stage of a historic financial reset that could redefine how silver is valued for years to come? Stay with us, because by the end of this video, the difference between paper silver and physical silver may never look the same again. Welcome to Next Alert, where we break down the economic signals that matter before they become tomorrow's headlines. If you're someone who believes that protecting wealth begins with understanding the bigger picture, then consider subscribing to our channel. It helps us continue bringing you careful research and in-depth market analysis designed for thoughtful investors like you. And before we begin, let us know in the comments, which country are you watching from today? We'd love to see where our Next Alert community is growing around the world. For decades, investors have assumed that the price flashing across commodity exchanges represents the true value of silver. Every rise and every decline has been interpreted as a reflection of supply, demand, and investor confidence. Yet beneath those familiar price charts, something far more significant may already be unfolding. A quiet transformation is beginning to separate the physical silver market from the paper market that most people follow every day. This shift has not been announced with dramatic headlines or emergency meetings. Instead, it is emerging through government policy, industrial demand, and strategic planning that very few retail investors are paying attention to. While many traders remain focused on short-term price movements, policymakers appear to be asking an entirely different question. They are no longer asking what silver is worth as an investment. They are asking what silver is worth if national security, advanced technology, and economic resilience depend upon it. That distinction changes everything. Around the world, governments are becoming increasingly concerned about securing reliable access to critical minerals. The conversation is no longer limited to oil, natural gas, or rare earth elements. Silver has quietly entered that discussion because modern economies rely on it in ways that were almost unimaginable only a generation ago. Artificial intelligence infrastructure, advanced semiconductor manufacturing, military electronics, renewable energy systems, electric vehicles, telecommunications, aerospace engineering, and next-generation medical technologies all require silver's unmatched electrical and thermal conductivity. In many of these applications, there is currently no practical substitute that delivers the same level of performance. This growing dependence has forced governments and large industries to rethink silver's role within the global economy. Rather than viewing it merely as a precious metal traded for profit, many strategic planners increasingly recognize it as an industrial resource that supports critical infrastructure. Once a commodity reaches that level of importance, the discussion naturally shifts from price speculation to supply security. History offers an important lesson. Whenever a resource becomes strategically essential, governments rarely leave its future entirely to free market forces. They develop stockpiles, diversify supply chains, encourage domestic production, negotiate international partnerships, and sometimes introduce policies designed to protect long-term availability. These actions often occur years before the wider financial markets fully understand their significance. This is where the idea of a silver price floor has captured growing attention. Contrary to popular belief, the discussion is not necessarily about governments declaring an official market price for silver. Instead, analysts are examining whether future policy frameworks could create economic conditions that encourage mining investment, protect strategic production, or stabilize supply chains during periods of geopolitical uncertainty. Such policies would not instantly force silver prices dramatically higher. Their real importance lies elsewhere. They acknowledge that uninterrupted access to physical silver may become more valuable than temporary fluctuations in quoted market prices. That raises a difficult question for investors. If governments are beginning to treat silver as a strategic asset, while industries continue consuming increasing quantities every year, why does the paper market often behave as though nothing has changed? The answer may lie in the growing difference between financial contracts and physical ownership. Most daily price movements originate inside futures markets, where enormous trading volumes consist of contracts rather than actual bars changing hands. These markets perform an important economic function by providing liquidity and price discovery. However, they also respond rapidly to interest rates, currency movements, algorithmic trading, hedge fund positioning, and broader investor sentiment. Physical demand operates under very different rules. Manufacturers cannot build advanced electronics with futures contracts. Defense contractors cannot assemble critical systems using digital positions on an exchange. Solar manufacturers cannot install paper silver into photovoltaic panels. Eventually, every industrial consumer requires real metal delivered to real facilities. That simple reality may become the defining force behind silver's next chapter. As the global economy accelerates toward an increasingly technology-driven future, the market could be approaching a moment where physical availability, not paper pricing, becomes the factor that ultimately determines silver's long-term value. There are moments in financial history when the market appears perfectly calm, even as the foundation beneath it quietly begins to shift. Silver may be entering one of those moments now. Every trading day, billions of dollars worth of silver changes hands across futures exchanges. Prices rise, prices fall, analysts publish forecasts, and algorithms execute thousands of trades in fractions of a second. To the average investor, everything appears normal. The market looks liquid, efficient, and transparent. But beneath that surface, another market has been telling a very different story. Imagine two worlds operating side by side. The first is the financial world. Here, silver exists primarily as contracts. Banks hedge positions, institutional investors speculate on economic data, and trading firms respond to changing interest rates or currency movements. In this environment, silver behaves like another financial asset whose value can swing dramatically within hours. The second world is entirely different. Here, silver is not a number on a trading screen. It is a physical resource that manufacturers cannot replace. Every ounce has a destination before it even leaves the refinery. It is transformed into semiconductor circuits, advanced radar systems, electric vehicles, artificial intelligence servers, high-efficiency solar panels, satellite communication equipment, and medical technologies that modern societies increasingly depend upon. These two markets used to move together. Today, signs suggest they are beginning to drift apart. One reason lies deep within the structure of global silver production. Unlike gold, which is mined primarily because companies are searching specifically for gold deposits, most silver enters the market as a byproduct of mining other industrial metals such as copper, zinc, and lead. This creates an unusual challenge. Even if silver demand suddenly accelerates, mining companies cannot simply double production. Their output depends largely on the economics of completely different metals. This structural limitation means supply reacts far more slowly than demand. Now consider what has happened over the past several years. Industrial consumption has steadily expanded as governments compete to modernize infrastructure. Companies race to build artificial intelligence data centers, renewable energy projects multiply across continents, and defense budgets increase in response to growing geopolitical tensions. Each of these developments pulls additional silver out of available inventories. Unlike investment demand, industrial demand rarely waits for better prices. A semiconductor manufacturer cannot postpone production because silver becomes more expensive. A defense contractor, fulfilling national security contracts, cannot simply eliminate silver from sophisticated electronic systems. A solar manufacturer building thousands of panels every day cannot replace silver with a cheaper material that performs equally well. Production must continue. Material must be secured. That creates pressure which often remains invisible to those watching only the daily spot price. Meanwhile, another important shift is quietly taking place. Large industrial buyers have become less concerned with purchasing silver at the absolute lowest price. Their priority is ensuring reliable access years into the future. In an era defined by supply chain disruptions, geopolitical rivalries, and export restrictions, certainty has become more valuable than temporary discounts. This subtle change transforms the entire conversation. Instead of asking, can silver become more expensive? Decision makers are increasingly asking, can we guarantee that silver will still be available when we need it? That is an entirely different risk. History repeatedly shows that strategic shortages rarely begin with empty warehouses. They begin with governments strengthening resource policies, manufacturers signing long-term supply agreements, refiners expanding inventories, and institutional buyers quietly accumulating physical assets before the broader market recognizes what is happening. By the time shortages become obvious, prices have often already adjusted. Perhaps the most remarkable aspect of today's silver market is not that prices continue fluctuating. It is that physical demand continues strengthening even during periods when paper prices weaken. That unusual behavior suggests the market may already be sending an important message. The quoted price still reflects financial expectations. The physical market is beginning to reflect strategic necessity. And if those two forces continue moving in different directions, the gap between them may eventually become impossible for the global market to ignore. While millions of investors continue debating where silver prices will move next, a far more important contest may already be underway. It is not taking place on commodity exchanges or inside investment banks. It is unfolding behind government offices, industrial boardrooms, and national security agencies, where the conversation is no longer centered on profits, but on preparedness. For decades, globalization encouraged nations to believe that essential resources would always be available somewhere in the world. If one supplier failed, another would step in. Markets were expected to solve shortages through price signals, and governments largely trusted international trade to keep supply chains functioning. That assumption is now being tested. Over the last several years, geopolitical tensions, trade disputes, regional conflicts, and supply chain disruptions have exposed a vulnerability that many countries underestimated. Economic power is no longer measured solely by military strength or financial influence. Increasingly, it is determined by who controls the materials required to build the technologies of the future. Silver sits at the center of that transformation. Unlike many commodities, silver occupies two worlds simultaneously. It serves as both a precious metal sought by investors and an industrial metal consumed by manufacturers. Every major technological revolution currently shaping the global economy depends, in one way or another, on silver's unique physical properties. Artificial intelligence requires enormous data centers filled with advanced processors and high-performance electrical systems. Renewable energy relies heavily on photovoltaic technology. Electric vehicles require increasingly sophisticated electronics. Modern defense systems incorporate highly sensitive communication equipment, radar technologies, and precision-guided components that demand exceptional conductivity. Each innovation quietly increases silver consumption. Individually, these industries may appear manageable. Collectively, however, they are creating a demand profile unlike anything previous generations experienced. The challenge becomes even greater when viewed from the supply side. Global silver production has never been designed to respond rapidly to sudden increases in demand. Most silver remains a secondary product, extracted while mining copper, zinc, or lead. This means production decisions often depend less on silver prices than on the profitability of entirely different mining operations. Even if silver prices rise substantially, bringing new production online is neither quick nor simple. Mining projects require years of geological surveys, environmental approvals, financing, infrastructure development, and construction before the first commercially viable ounce reaches the market. During that lengthy process, industrial demand rarely pauses to wait. Time becomes the market's hidden constraint. This reality has encouraged governments to rethink their economic strategies. Rather than relying exclusively on international markets during future crises, many nations are strengthening domestic production, diversifying import sources, supporting strategic mining projects, and expanding critical mineral partnerships. These initiatives are not limited to one region or one political system. They reflect a broader recognition that resource security has become inseparable from economic security. Perhaps the most revealing development is not what governments are saying publicly, but how institutions are behaving privately. Long-term supply agreements are becoming increasingly common. Industrial consumers are showing greater willingness to secure future deliveries well in advance. Strategic stockpiles are receiving renewed attention. Mining companies are finding themselves at the center of policy discussions that once focused almost entirely on energy resources. These actions send an important message. Participants closest to the physical supply chain appear more concerned about future availability than short-term market volatility. Financial markets, however, often respond differently. Algorithmic trading systems continue reacting to inflation reports, employment data, central bank speeches, and interest rate expectations. These variables certainly influence precious metals in the short run, but they do not necessarily capture structural changes unfolding over years rather than weeks. That creates an unusual situation. One market continues pricing silver primarily as a financial asset. Another increasingly treats silver as a strategic necessity. History suggests that such differences rarely persist forever. Eventually, markets tend to reconcile conflicting realities. Sometimes, that adjustment occurs gradually through the years of steady appreciation. Other times, it arrives unexpectedly after a single geopolitical event, supply disruption, or policy decision exposes weaknesses that had been developing quietly beneath the surface. No one can predict exactly when such a turning point might occur. What can be observed, however, is that the forces supporting silver today are broader than traditional investment demand. They extend into industrial policy, technological innovation, national security planning, and global competition for strategic resources. If those trends continue accelerating together, the future of silver may be shaped less by daily trading activity and more by decisions being made far from commodity exchanges. And that possibility leads to one final question. If governments, manufacturers, and institutional buyers are already preparing for a world where physical silver becomes increasingly strategic, what happens when the broader investment community finally begins to recognize the same reality? Financial markets have a habit of reacting only after a structural shift has already taken place. By the time headlines begin declaring that a commodity has become strategically important, governments have often spent years preparing for that reality. Corporations have already secured long-term contracts. Institutional investors have quietly adjusted their portfolios. Supply chains have already been redesigned. The public usually arrives much later. That may prove to be the defining lesson of today's silver market. Throughout this discussion, one theme has remained remarkably consistent. The question has never been whether silver is valuable. Its value has been recognized for centuries. The real question is whether the global financial system is still pricing silver according to yesterday's economy while the physical world has already entered tomorrow's. If that assumption proves correct, the implications extend far beyond a simple rise or fall in spot prices. They reshape how investors should think about risk. Many market participants continue evaluating silver through the lens of traditional investment cycles. They monitor inflation reports, central bank decisions, employment data, and currency fluctuations. These factors undoubtedly influence precious metals and will continue doing so. But another layer of influence has quietly emerged: strategic demand. Unlike speculative demand, strategic demand is not driven by quarterly returns or market sentiment. It exists because governments cannot postpone national security projects, manufacturers cannot delay production indefinitely, and technology companies cannot build next-generation infrastructure without securing the raw materials their industries require. That makes strategic demand remarkably persistent. Even during periods of economic uncertainty, essential industries continue operating. Defense systems continue being manufactured. Electrical infrastructure continues expanding. Artificial intelligence requires increasingly sophisticated hardware. Renewable energy projects continue consuming conductive materials at unprecedented levels. These are not temporary market trends. They represent long-term structural commitments. This is precisely why a discussion surrounding potential policy support, critical mineral strategies, and industrial security deserve far more attention than short-term price volatility. Whether governments eventually introduce formal price support mechanisms, targeted production incentives, or stronger strategic reserve programs is almost secondary. The larger message has already been delivered. Silver is no longer being viewed solely through the lens of investment demand. It is increasingly being evaluated through the lens of national resilience. History demonstrates that once governments redefine a resource as strategically important, investment markets often require years to fully appreciate the consequences. Oil experienced similar transformations during previous geopolitical crises. Semiconductors became strategic assets almost overnight after supply chain disruptions exposed global vulnerabilities. Rare earth elements evolved from relatively obscure commodities into critical components of international economic policy. Silver may now be entering a comparable chapter. None of this guarantees a straight path higher. Markets rarely move in one direction for long. There will continue to be corrections, periods of uncertainty, unexpected policy changes, and economic slowdowns capable of temporarily pressuring prices. Investors should never assume that structural strength eliminates market risk. In fact, disciplined decision-making becomes even more important during periods of heightened uncertainty. Successful long-term investors rarely build wealth by reacting emotionally to every headline. Instead, they focus on identifying structural trends before those trends become widely accepted. That may be the greatest lesson hidden inside today's silver market. The most significant opportunity may not lie in predicting next week's price movement. It may lie in recognizing that the relationship between paper pricing and physical availability is gradually evolving into something fundamentally different from previous market cycles. If physical inventories continue tightening while industrial dependence expands and governments strengthen critical mineral policies, the market may eventually reach a point where quoted prices are forced to reflect realities that have existed quietly for years. By then, the debate will no longer be about whether silver has become strategically important. That question may already have been answered. The only question remaining will be whether investors recognize the shift early enough to understand what was unfolding before the rest of the market caught up. As always, no single policy announcement or market forecast should replace careful research and disciplined thinking. Economic history repeatedly rewards those who pay attention to long-term structural changes instead of daily market noise. Thank you for spending your time with Next Alert. If you found this analysis valuable, consider subscribing and becoming part of a community that looks beyond the headlines to understand the forces shaping tomorrow's economy. Now, we'd like to hear your perspective. Do you believe physical silver is beginning to separate from the paper market? Or do you think both will continue moving together in the years ahead? Share your thoughts in the comments below. The discussion may reveal just as much as the market itself.